back to the Fire Grind. My name is Daniel, and on this channel we talk about personal finance, and we have a focus in the stock market and how to invest to increase your wealth. In this video today, we'll be going over the TFSA, the RRSP, and the non-registered or personal account, as Wealthsimple calls it. These three accounts are available for you to open if you're using Wealthsimple Trade, and as well as if you're using any other brokerage within Canada, you can open these accounts as well. So I'll be first going over what each of these accounts are and giving you a quick summary of them, then going over my opinion on when I would use each one and maybe the order that you should consider putting your money into the accounts. And lastly, I'll be going over the different nuances with each account because there are certain things that you should know. This is not a comprehensive list, but these are probably the most important ones that you might want to know if you're going to be signing up for one of these three accounts. Before we get onto the content, I just want to tease in my next video. And my next video will actually be on Air Canada stock. So if you're interested in my thoughts on Air Canada, we'll be going over the finances, my thesis for it, and whether I'm buying it or not. Just click that subscribe button so you don't miss that video. So starting off, we have the personal account. And this account is called Personal Wealthsimple. However, other brokerages like TD might call it a non-registered account. Another name for this account could basically be a taxable account, because every penny that you earn in this, whether it's from dividends or capital gains, they're all subject to tax. And later on in the nuances section, I'll be talking about the taxes that you might see on these accounts when you make a capital gains or dividends, because the rates are different. So the personal account or non-registered account is the easiest account to open. There's the least restrictions on this account as well. So you can deposit basically an infinite amount of money into this account or withdraw the money at any point in time without having to worry about the government coming after you for doing something that was against the rules for this account. Now moving on to the TFSA account. The TFSA, or the tax-free savings account, was introduced in 2009. And every person who is over the age of 18 since 2009 has the maximum contribution limit. If you aren't over the age of 18, then your contribution limit to this date is less than the maximum, and I believe the maximum is around $69,500. So in this tax-free savings account, anything that you gain, whether it's capital gains or dividends, is tax-free. Just note that if you bought US dividends though, there is a withholding tax for the US stock, and that happens on the US side. On the Canadian side, you're not taxed for the dividends at all. In order to find out the amount that you're able to contribute to your TFSA account if you weren't 18 in 2009, you can click on the link down below in the description. I believe it's something along the lines of moneysense.com. You just have to enter in the age that you turned 18 and it'll spit out a number telling you how much you can contribute to date. And that's also assuming that you haven't contributed anything to this date. Later on in the nuances section, I'll be talking about if you have contributed to your TFSA, how to figure out how much contribution room you have left if you haven't been keeping track. Now the RRSP is the last account out of the three accounts that we're going to talk about. The RRSP, or the Registered Retirement Savings Plan account, is meant to help you save for retirement. So any money that you put in there is also like the TFSA tax sheltered. However, the difference for the RRSP account is that any money you put in there, you can deduct that amount off of your income tax, therefore lowering your current income tax. But really, you're just deferring that income tax to later on, because when you withdraw money later on down the road when you retire, the amount that you withdraw is going to count towards your income and you'll have to pay income tax on that. But likely it'll be a lower amount because the amount that you withdraw will probably be less than what you're making currently, so your tax bracket will actually be lower. To figure out how much contribution room you have to take your income each year and multiply it by 18%. In each year, there's also a maximum amount that you can contribute to the RRSP, so if that 18% multiplied by your income is larger than that maximum amount, then you're capped at that maximum amount. If you don't know how much contribution room you have, typically on your income tax return, it'll actually show you that. Otherwise, you can Google online and just figure out what were the maximum amounts each year and do the calculations yourself. For the RRSP account, technically you can actually withdraw from it at any point. However, if you do so before converting it to a RRIF, you will be subject to withholding tax, as well as the amount that you withdraw will be put towards your income and taxed based on your income tax rate. So basically you're being double taxed, so this should deter you from actually withdrawing from your RRSP as long as you are making an income. And if you do want to withdraw from your RRSP earlier, you should convert this into RRIF account and just do some Googling to figure out what an RRIF account is. I will be giving a bit of detail on the RRIF in the nuances section later on, but it won't be very comprehensive. So now the real question is, how and when should I use each account? There's a bit of a strategy behind which account you should fund first over the other ones, and I will be explaining that right now. So starting off with a personal account, when should you use this account? My answer to this is basically you want to use this account last after you've maxed out your TFSA and your RRSP for that year. So there is a case that you might want to use a personal account, and this is if you're experimenting with different forms of investment that are a lot more riskier. For example, if you're day trading or trading penny stocks or even options. If you have no experience doing this and you're experimenting, you likely will stand to lose most of your initial investment. And if you do that in a TFSA account or an RRSP account, that contribution room is gone forever if you lost that amount. However, in a personal account, if you have a capital loss, you're able to carry that capital loss over to the years afterwards until you use it up. So this capital loss that you're carrying over is used to offset any capital gains in the future. So for example, if you lost $3,000 this year in your personal account and next year you gain $5,000, essentially for the year after, your taxes will claim that you have capital gains of $2,000 because $3,000 of capital losses offset that $5,000 of capital gains. Now between the TFSA and the RRSP. For the TFSA, this is great if you want to be able to withdraw money at any time in case you need it for investments like buying a house or buying a boat if you're into that. And withdrawing from the TFSA does not subject you to any sort of income tax or withholding tax. And now for the RRSP, if you want to just throw away money for retirement, you want to stick in the RRSP, as well as if you expect your income not to rise dramatically over the next 10-20 years, I would also encourage you to put your money into the RRSP rather than the TFSA. The reason why I say this is because when you deposit into the RRSP, you also get an income tax rebate, which is basically more money in your pocket currently, which you can use to invest in your TFSA account. And if you're able to put money in the market sooner, you have a longer time for it to grow, and therefore time is on your side. But for those of you who are currently young in your career and expecting your income to increase significantly over the next 5, 10, 15 years, you may want to take a look at the spreadsheet that I've made to figure out, is it worth it for you to claim that income tax now or defer it to later on when your income tax is higher. So I'll go over an example to illustrate both sides of the coin using the spreadsheet that I created, and it's available in the description down below. Just edit the cells that are beside the boxes highlighted in yellow. Everything else is locked, so you won't be able to edit that. This is just so that people who are also using this after you, the formulas don't screw up. So for example, if you're 25 and you're making $40,000, you'll pay 20% tax, which we see down here, and you will also have an RRSP contribution room that year of around $7,200 based off of 18% of your $40,000. So the tax back that you can claim if you're depositing $7,200 into your RRSP account is around $1,443. If you save this $7,200 for later on, and let's say at the age of 35, you estimate you'll make roughly $80,000, you'll be able to get back $2,157 based off your income tax bracket there. And at around $80,000, your income tax bracket will make you pay anywhere from 29 to 31% in income tax. So at face value, this is amazing because if you save your RRSP contribution till the age of 35, you can get back $2,150 instead of $1,440. However, you have to consider that if you got that money earlier, basically by 10 years, how much could you grow that in 10 years? And that's where the trick in this whole equation lies. So right here on the right side, we can see that I have a bit of a column just outlining amounts that are in the future. So you want to first enter what your predicted interest rate is or your growth of investment. So typically the stock market actually yields around 7% per year if you account for inflation, but we're going to assume 4% because we're conservative. And the fact that you're earning $80,000 at around 35 years of age versus $40,000 at 25, this is delaying your tax back by 10 years. So if we do some compound interest calculations, we can see that if you actually claimed your tax back today at the age of 25, you can grow that $1,443 to $2,136 in 10 years at a 4% interest rate. So is it worth it for you to invest in the RRSP today? The answer is no, but it's by a margin of $20, which is actually quite tight, so it's kind of anyone's game at this point. However, if we increase this to like 7%, we can see that you can grow that $1,400 to about $2,800. So it definitely is worth it for you to use your RRSP contributions today and get that income tax back if you're gonna earn this $80,000 salary, and that's gonna be 10 years down in the future. But for those of you who are currently just using a high interest savings account and maybe earning 1% interest because the interest rate sucks, you're gonna see that you're only gonna be able to grow your $1,400 to around $1,600. So you definitely wanna save your RRSP contribution room if you expect your income to basically double in 10 years. So obviously you can play around with the spreadsheet however you like. You can change up the number of years based on the expected salary that you expect to earn in the future. So maybe in your company you have like a milestone. If you hit 3 years, you get promoted to a senior of some sort of position and your salary bumps up by $20,000. So let's say you earn $40,000 now and you change it to $60,000. The calculator instantly changes everything. The calculator also gives you a breakdown of your taxes for each tax bracket, and you can see that just down here. So I've labeled, there's 4 different calculators here, and there you can just read the labels to see what each one does. And the rates that I use for the following calculation are actually from this website. So if you're interested, you can go ahead and check that website out to see the different tax brackets. So these tax rates are actually the Ontario provincial combined with the Canada federal tax rates. So if you're from a different province, the rates will be a little bit different for you, but roughly the same, I would say. But you'll be able to get a gist of how close it is between getting tax back today versus delaying it till later on. I know there are probably other cases out there that I've missed, and if you're interested in my opinion on your particular case, if I didn't actually cover that in this video, you can leave that in the comments down below, or just send me an email at thefiregrind@gmail.com. Also, while you're at it, please just smash that thumbs up button. It really helps promote my content to other users like yourself who are interested in these 3 accounts, and it's just supporting my channel, so I'd greatly appreciate that. Now moving on to the nuances of each account. First off, we're going to talk about the personal account and go over the nuances of this account. So the first nuance we're going to talk about is the taxes that you might see based off of the capital gains and dividends. So how capital gains tax works in Canada typically is that any capital gains that you earn, 50% of that is added to your income. So if you earned $2,000 in capital gains, $1,000 is going to be tacked onto your income. And basically you're going to be taxed on that $1,000 based off of your income bracket there. So if you earn like $70,000, basically this extra $1,000 is going to make your total income to $71,000. And if you use that tax calculator that I gave you earlier, you can find out how much tax you're going to have to pay on $71,000 versus $70,000. But I mentioned before, if you have a capital loss that you've carried over from previous years, that actually will offset any sort of capital gains you have in the current year. And now moving on to the tax rate for dividends. For dividends, there are 2 types of dividends. There's an ineligible dividend and there's also an eligible dividend. And I won't go over the differences between these 2. You can actually do some Googling on your own to figure out what's the difference between these 2. However, the maximum amount of tax you'll see on dividends is essentially 29%. And this is if you're in the highest income tax bracket. So if you're not in the highest income tax bracket, you're going to see less than 29% income tax on these dividends that you receive in your personal account. For the TFSA account, the first nuance we're going to go over is there is a case where you can actually deposit more than the maximum amount. That is, if you made withdrawals in the past that actually equal to larger than the amount that you're allowed to contribute. So for example, up to this year, if you've contributed the maximum amount and you're 18 before the year 2009, you contributed $69,500. And let's say you grew that $69,500 to $100,000 and you withdrew that $100,000 this year. The next year in 2021, that contribution room actually goes back in as $100,000, not $69,500. So basically, if you grew your account to $1 million and you withdrew $1 million this year, you could put back in $1 million next year. And any contribution room that's added on next year will actually be added towards that $1 million that you withdrew. Where can you find your contribution room remaining? You're able to find your contribution room remaining if you go onto the CRA website and you sign into your account. If you don't have an account, you should register with the CRA. You just have to register online and they'll send you some mail later on in about 7 days with the passcode to set up your account. Your TFSA contribution room, however, on the CRA website is not up to date in real time. They usually update your TFSA contribution room once a year, and that will usually come out around, I think, February or March, and this will be for January 1st of that year. So any amount that you deposit after January 1st will not be accounted in that, so you should keep track of that or just look at your bank statements. The last thing that I want to mention about the TFSA account is you can actually use a bit of a strategy in order to maximize your TFSA account. And here's the strategy. So if you feel like one of your stocks are currently overvalued in your TFSA account, you can sell it off and move the cash out to your personal account and buy it in your personal account. And what this will allow you to do is still keep the stock, but not keep it in your TFSA account where you stand to lose quite a bit if the stock is going to fall because it's overvalued. However, you're going to see the loss in your personal account, and if you move it back into your TFSA account after that loss happens, you can actually take a capital loss out there and offset any other gains in your personal account. However, if you take a capital loss in your TFSA account, basically that doesn't count for anything because any earnings or losses in your TFSA account are not taxable or used as a tax credit. So this is a trick that you can use to rotate overvalued stocks out of your TFSA account and undervalued stocks into your TFSA account. So in Wealthsimple, you can't actually transfer shares from your TFSA to your personal. So how you can do this instead is if you have an overvalued stock in your TFSA, just sell it off and keep the cash in there, or maybe buy another undervalued stock in your TFSA account, and then you can buy that overvalued stock in your personal account. So essentially you haven't lost out on any gains or incurred any losses. If that overvalued stock actually drops down and ends up becoming undervalued, you can sell it off in your personal account, incur a capital loss which you can use to offset other capital gains in your personal account, and then go back over to your TFSA account and buy that stock that used to be overvalued and now is undervalued. In this way, you can buy back that company that you really love and it's undervalued now and ride it back up again to the point where it becomes fair valued or overvalued. And you can rinse and repeat this strategy with multiple stocks if you want. And finally in this video, we're going to talk about the nuances with the RRSP. So there are actually two different cases which you can withdraw from your RRSP before you retire and not incur any sort of withholding tax or income tax. And this is if you qualify for the homebuyer plan or the lifelong learning plan. So the homebuyer plan is essentially for first-time home buyers. If you're purchasing your first home, you can withdraw from your RRSP up to $35,000 per partner or spouse. So basically, if you're married, you're able to take out $70,000 total from your RRSP account from each person. And if you're single, you can just take out $35,000 if you have that amount of cash in your RRSP account, that is. The one caveat with this all is that you need to repay that amount that you withdrew in the 15 years following the withdrawal. For the lifelong learning plan, if you plan to pursue a full-time education or training in the middle of your career, you're able to take those years off and actually withdraw $10,000 per year for up to 2 years, so a total of $20,000 to support you while you're taking your full-time training or education. However, this $20,000 that you withdrew, or whatever amount you withdrew that's less than $20,000, must be repaid in 10 years following the last time you withdraw under the lifelong learning plan. And now we're going to talk a bit about the basics of the RRIF to end off this video. For the RRIF account, you can open up this account at any point and convert your RRSP into this account. But the reason why you might not want to do that is you're required to withdraw a certain amount of money from this account each year. So the formula to determine the minimum amount that you must withdraw from the RRIF account each year is essentially the amount in your RRIF account multiplied by 1 divided by 90 subtract your age. So the younger you are, the less you're required to withdraw from this account. However, just note that the minimum amount that you withdraw is not subject to withholding tax, but it is tacked onto your total income for that year. And any amount that you withdraw over the minimum amount is actually subject to withholding tax as well as income tax. The formula no longer applies when you hit the age of 72. There's actually a predetermined rate up to the age of 95 where you have to withdraw a certain amount, and if you're interested in what those rates are, you can click on another link in the description below, which I have there to show you what those rates are from the age of 72 to 95. And essentially it goes up to about 20% that you're required to withdraw from your RRIF when you hit 95. And one other thing, when you hit the age of 72, your RRSP is automatically converted into an RRIF account. So basically you're required to withdraw from this account starting at the age of 72. So most people don't talk about opening an RRIF account until you hit retirement. However, there may be the case for you to set that up if you're retiring early at the age of like 30 or 40, especially if you're on the FIRE movement, or if you're wanting to take a sabbatical from your job for a year to take care of a family member or just to go travel. So let's say at the age of 30, you want to take a sabbatical, you can open up an RRIF account and transfer funds from your RRSP account over to that RRIF account. And basically, you're just going to have to follow the formula for the minimum withdrawal each year. You have to withdraw this minimum amount, and any amount on top of that is actually subject to withholding tax based off of the rates that I'm going to throw up on the screen right now. But you can also convert that RRIF account back to an RRSP account if you're under the age of 72. You just have to do a bit more paperwork. So let's say you just want to take a year off and you just want to be able to withdraw from your RRSP account, convert that to an RRIF account and withdraw for 1 year and convert it back to an RRSP account. So that's about it that I have on the TFSA account, the RRSP account, as well as the personal or non-registered account. If you have any questions or comments, leave them down below. Also subscribe to my channel as I continue releasing more content on personal finance as well as the stock market. And if you got any value out of this, please just smash that thumbs up button, as it really helps me as a YouTube creator to continue creating more content for you that is valuable. And if you know anyone else who's also confused about these 3 accounts, just share this link with them. Keep up the grind and have a great day.